As of Friday, May 1st, 2026, the markets officially closed for the week, and Supermicro Computer Inc., widely known by its ticker SMCI, finished the session at $27.09. This represented a slight dip of about 1.09% for the day. While the headline number might look like a standard quiet Friday, the underlying price action during the session told a much more volatile story. The stock actually managed to push as high as $28.30 earlier in the day, teasing investors with a potential breakout, before gravity set in and pulled it back toward the low of $26.87. This intraday swing is exactly the kind of tension that has come to define the Supermicro experience lately. On the surface, the narrative is all about the massive demand for AI infrastructure, but the reality is a stock that is currently fighting for its life to maintain a psychological floor near the $27 level. For those looking for investment help in these choppy waters, understanding the gap between the optimistic top-line growth and the deteriorating margins is the only way to navigate what is coming next week. What most people are missing right now isn't the sales growth. We know that's through the roof. The real insight lies in the upcoming earnings report scheduled for May 5th. While the crowd is focused on whether they will hit their $12.4 billion revenue target, the true make-or-break metric will be the gross margins. In the previous quarter, margins collapsed to a startling 6.3%, a far cry from the double digits investors were used to. If you are using investing sites to track this, you'll see the expectation is for a recovery, but the reality of high liquid cooling costs and fierce competition from Dell and HPE might provide a reality check that the market isn't prepared for. This creates a fascinating setup where the stock could report record revenue and still see a sell-off if the profitability doesn't show signs of a floor. It is this specific disconnect between being a volume leader and a profit leader that determines whether SMCI belongs in a long-term individual brokerage account or remains a high-risk trade. Looking at the broader landscape, nvidia stock and Tesla stock often grab the headlines for AI and automation, but Supermicro is the physical manifestation of that hype. They are the ones actually building the racks and the cooling systems that allow these high-powered chips to function. However, the market has shifted its gaze from can they build it to can they make a profit building it. Recent trading volumes show a high level of institutional activity, but it hasn't been the aggressive buying we saw in early 2024. Instead, it looks like large players are hedging their bets, waiting for the May 5th data to confirm if the cash burn is temporary. Many retail traders using the Robinhood app or Robinhood stock trading platforms have been trying to catch the falling knife near the 52-week lows of $19.48, but the stock is currently caught in a medium-term falling trend channel. Until it can convincingly break above the $29 resistance level, the path of least resistance remains sideways or down. The current sentiment around Supermicro is a classic battle between momentum and fundamentals. If you look at the Fidelity mobile app or use the Fidelity trading platform, you'll notice that SMCI's relative strength is quite low compared to the rest of the technology hardware sector. In fact, more than 80% of stocks in the broader market have outperformed SMCI over the last year. This is a staggering statistic for a company that is supposedly at the center of the AI gold rush. The common ground among investors is that the demand for AI servers is permanent, but the contrarian view, the one that forces you to rethink the position, is that the hardware side of AI is becoming a low-margin commodity business faster than anyone expected. If Supermicro has to keep cutting prices to win contracts against legacy giants, the AI premium currently baked into the stock might continue to evaporate. Comment below how many shares of Supermicro Computer you currently hold and whether you think they can get their gross margins back above 10% this year. When we look at the daily swings, we see a company that is hypersensitive to macroeconomic pressures and sector momentum. For instance, when nvidia stock has a strong day, SMCI often follows, but lately the correlation has been breaking. Supermicro has been lagging, which suggests that investors are starting to differentiate between the chip designers who hold the intellectual property and the server integrators who handle the low-margin physical assembly. This distinction is critical for anyone involved in self-investing or using online investing tools to build a portfolio. You have to ask yourself if you are buying a technology leader or a manufacturing firm. The business model of Supermicro relies on its data center building block solutions, which are essentially modular server designs that allow for rapid customization. This was a massive advantage when the AI wave first hit, because they could move faster than Dell or HP. But now that the giants have woken up, that lead is narrowing, and the cost of maintaining that lead is showing up as a drain on working capital. Technically, the stock is in a fragile spot. While the RSI curve has shown a slight rising trend, often an early signal of a trend reversal, the price remains below its 50-day and 200-day moving averages. For those who manage their own portfolios through Interactive Brokers or use an Interactive Brokers account for sophisticated trading, these technical hurdles are significant. A move above $29 would be the first sign of life, but the real test is at the $36 mark. On the downside, if earnings on May 5th disappoint, we could see a retest of that $20 support level very quickly.
The volatility here is high, with an average true range that suggests massive daily moves are the new normal. This isn't a stock for the faint of heart, and it certainly isn't a set-it-and-forget-it type of investment that you'd find in something like Schwab Intelligent Portfolios. It requires active management and a constant eye on the news cycle. Supermicro's recent history is a story of explosive growth met with operational growing pains. They recently announced plans to scale up to 6,000 racks per month, including a heavy focus on direct liquid cooling. This is essential for the next generation of chips, like the nvidia Blackwell platform, which generate immense heat. The expectation is that being first to market with liquid cooling racks will give them a defensive moat. However, the reality is that scaling this fast has led to inventory issues and a lengthened cash conversion cycle. They are essentially a victim of their own success, needing more and more cash to fund the parts and labor for these massive orders before they ever see a dime from the customer. This is why the cash flow statement in the upcoming report might be even more important than the earnings per share. Investors want to see that the company can actually collect the revenue it's booking. For those utilizing Fidelity investments or looking into Fidelity ETFs that hold SMCI, the concentration risk is also worth noting. A large portion of Supermicro's revenue comes from a very small handful of giant data center customers. If one of those customers decides to diversify their suppliers or build their own hardware, the impact on SMCI would be catastrophic. This is the reality that often clashes with the expectation of infinite growth. The future outlook for the company hinges on its ability to transition from a high-growth hardware startup to a stable, profitable industry leader. There are catalysts on the horizon, specifically the integration of the Blackwell GPU platform, which should drive revenue well into 2027, but the risks of execution and margin compression are real and immediate. If you are using platforms like SoFi Invest or the SoFi Active Investing tools, you've likely seen the wide range of analyst price targets for this stock. Some see it heading back to 70, while others think 15 is more realistic. This massive spread tells you everything you need to know about the uncertainty surrounding the company's valuation. It's not just about the numbers, it's about the narrative. Is this a company that will revolutionize data center efficiency, or is it just a middleman in a very expensive supply chain? The way you answer that question determines how you should play the upcoming earnings. As we head into next week, the expectation is high for a revenue beat, but the reality of the balance sheet will be the final judge. In summary, Supermicro Computer remains one of the most polarizing names in the tech sector. We started with a closing price of $27.09, but the path to that number was paved with the same tension that defines the entire AI industry right now. We've seen the expectation of total market dominance clash with the reality of shrinking profits and heavy competition. The insight to carry forward is that revenue is no longer the metric that matters. Watch the margins and the cash flow. The company has the tools and the partnership with nvidia to remain a major player, but the financial execution must catch up to the technological ambition. Whether you are trading on the Robinhood app or managing a complex portfolio through Fidelity Wealth Management, the May 5th earnings call is the next major pivot point. Stay focused on the data, not the hype, because in a market this volatile, the gap between what people believe and what the numbers show is where the real opportunity and the real risk is found. Maintain that sense of depth in your analysis, and don't let the intraday noise distract you from the structural shifts happening within the company's business model. Authority in this market comes from recognizing the risks before they become headlines. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends. Bell, subscribe for more updates.